And I want to introduce and welcome everybody to today's session. It's today's is I think the fifth in our series of webinars that we've been doing here at Millionacres, going back to the fall, part of our live webinar series. Today is tax benefits for real estate investors, and it's going to be featuring someone I'm excited to introduce, Blake Christian, who I'll introduce in just a moment. We can go to the next slide, Blake, and we'll just do a couple of quick. Who is Millionacres? Why are we talking to you today? So real quick, in terms of, before we get into the topic, who's Millionacres? We are a Motley Fool service. So we're a company that's grown out of the Motley Fool, part of the Motley Fool family of services. And if you're, not familiar with the Motley Fool, it's a company that's been around for the better part of 30 years. Essentially providing financial stock picks and a variety of different services, everything from wealth management now to credit card services, et cetera. There's a wide array of financial services that the Motley Fool makes available to its subscribers. Millionacres is one of those. And, we are an organization dedicated exclusively to making real estate investing an accessible tool for everyone. Real estate investing is one of those things that you always hear no other investment has made more millionaires and billionaires than real estate. And that's a very true thing. And I think a lot of folks believe on the surface that real estate investing is potentially beyond them because they think they have to, physically buy properties or et cetera. That's not always the case. So there's a lot of avenues to get started in real estate investing. Now, today's topic is going to really dig into the tax side of it, which is very, very important. And I think it's a very important topic, especially for folks who are getting into short-term rentals or other type of rental properties or just generally other type of properties in general. So with that, a couple of quick things in terms of the Millionacres services. We offer multiple investing products. And the names of them are as follows. There's Real Estate Winners, there's Mogul, and there's Trailblazers. Trailblazer is actually a new product that we're debuting in June. These products are essentially, as simple as Real Estate Winners is going to provide monthly recommendations on, key real estate stocks that you can acquire. And our real estate stocks and REITs are outperforming the S&P now, going back to the 70s. So there's some great benefits to that. The services are typically include stock recommendations or advanced advice, like you're going to hear some today on residential and commercial real estate investing. So I don't want to go too much into the details on that side of it. We'll certainly follow up with more information on who we are. So let me take a minute and introduce Blake. Blake's going to pick the presentation up and take us through the rest. So Blake, I want to just have you come on and tell the folks just a little bit about you and about your company, and then I'm going to sit back and enjoy the presentation.
Okay, great. Really appreciate the opportunity to speak today, Kevin. Thank you. So I've been a CPA for 40 years. I started my career in Los Angeles with KPMG, one of the big four firms. Currently, I work for Holthaus, Carlin & Van Trite. We're a top 30 firm in the country. We have 13 offices, about 700 total head count. I split my time between Park City, Utah, and Long Beach, California offices. I pretty much holistic tax planning for high net worth individuals and companies, and I specialize on a national basis in the Opportunity Zone program. We've set up over 100 Opportunity Zone funds and well over 125 qualified Opportunity Zone businesses, which probably puts us, in the top 3 to 5 firms as far as volume in this space. Dollars in those funds is about $1 billion of equity. Projects that will spin off of those funds probably in the $10 billion range over the next 10 years. And also on a personal note, I actually formed my own Oz fund. I have a company that we convert shipping containers into housing and other special purpose buildings. So we're in the process of buying a building in Provo, and then we'll have a manufacturing operation in there. So before we jump in, and Kevin, I'm sorry, did you have any other comments or do you want me to jump in?
No, Blake, please take it from here, and I'll come back on at the end. Okay,
great. I did want to make some key points before I get into the slides so I don't forget these because they're really important. I mean, first of all, the Oz program is by far, I've been doing this again for 4 decades, absolutely hands down the most flexible and impactful economic development tool that I've seen in my career. It's very, very well designed. It's been very successful out of the blocks, and we've got decades that we can run this program. So it's an exciting program. Glad you tuned in today. Any type of capital gain can be used in this program. The reason I'm laughing is I was talking to somebody that works at an Oz fund, and he was telling me, oh, I thought only real estate gains could get rolled into an Oz fund, but it could be cryptocurrency, stock market gains, collectible car, art, anything that generates a capital gain can be rolled into an opportunity zone fund. And there are hundreds of what I'd call public opportunity zone funds that you can invest in. But most of what I do is we set up funds that are just captive for that person that had a big capital gain event. So you can set up your own and cut out a lot of the cost that you would have in investing in a third-party fund.
Like, real quick, do you want to advance your slides here real quick?
Oh, I'm sorry.
Yep.
But there are some good ones out there. The other thing is you can have both real estate as well as operating businesses in an Oz fund. And if you have an operating business, many of those, as long as it's not a straight service business, those can also qualify under Section 1202, qualified small business stock, that you could exit that within 5 years and still get up to a $10 million per investor exemption and not have to hold the investment for the full 10 years. Now, in a real estate, you're still going to have to hold that for 10 years, but oftentimes we have both operating businesses as well as real estate in an opportunity zone fund. The other really powerful thing that doesn't get a lot of press is depreciation recapture in a real estate investment is kind of annoying at the end that you have to pay ordinary tax rates on those. In an Oz context, all of that depreciation goes poof at the end of the 10-year period. So that just enhances your overall, you took all those deductions as ordinary deductions during the 10-year period. On an average building, you'd probably depreciate half of that over a 10-year period. And none of that gets recaptured at the tail end. You have to be very careful on structuring, especially if you already own land and now you're going to put it in an Oz fund. That gets real tricky. You definitely want to talk to a tax attorney or a CPA that really knows this area. And we get the question asked a lot, there's no magic during the 10-year period. 90% of these are set up as tiered partnerships. All the activity is going to come through on a K1 every year, and you're just going to pay tax or get a loss on your K1. It's just like any other investment. You don't get any exemption during the operating period, but the big payoff is after the 10-year period, tax-free for federal and all but 5 states. Final thing, just want to point out that 1031s can be used within the opportunity zone once it's already set up. So you could trade out properties along that 10-year period. Cost segregation still works. And you can also, what's called twinning, you can use a lot of other state and federal programs like tax credit programs, solar, et cetera, are all eligible to be used during the operating period. You've heard that last night's speech, and even prior to that, Biden is talking about jacking up the capital gain rates. And we could be in a situation where we could have a 43.4% long-term capital gain rate for people making more than $1 million, which would be pretty disastrous. If that happens, the Opportunity Zone program even becomes more appealing because tax-free income in a high-rate environment is even more valuable. So just quick kind of where we are in the Oz program right now, 3+ years into the program. It started in 2018, effectively. We've got $16.34 billion committed to the program at this point in equity. But as I was mentioning earlier, that's just the equity piece. Obviously, there's going to be debt in that capital stack. So that translates into, you could probably multiply that by 4 or 5 to get to how many projects are out there. This figure was calculated by Novogradac, who's kind of the real leader and do a great job of gathering this information. And by their own admission, that's probably a low number. The White House during Trump's final month had the numbers they released were more like 75 billion had been put in. Now, granted, I think they were rounding up a lot, but the bottom line is like the 100 that I have is not in there because they're not trying to raise funds. They're already self-sufficient. And so there's a whole bunch of other funds that aren't on the radar. But needless to say, there's a lot of money going into the program. Funds, again, probably lowball numbers, but as of March 31st, the amount of qualified opportunity funds that have actually got their equity already in, there's 708 of those by Novogradic's calculation. And then there's also another 300 or so that are formed but are still waiting for their equity infusions. The average investment size from outside investors is about $250,000. They also threw out that the age of the average investor was 51 and male, but some interesting statistics. This slide is very interesting. California is the clear leader, and that is happening even though California at the state level does not adopt the program. So if you're a California resident and you roll into an Oz census tract in California, you're not going to get any of these tax benefits that we're talking about today. But still, it's such a hot market. There's just been massive infusions there. New York, I highlighted that one also. It's baffling to me, but they just what we refer to as decoupled from the federal program. So effective January of 2021, you're not going to get the deferral benefit. We're not sure if it's just a flaw in the way that they passed the legislation, but the consensus is the way it's written, you would still get the 10-year exemption, but you just wouldn't get the deferral on the state side. If you've had, and I have many clients that set those up in New York prior to 2021, those should be grandfathered, but that just happened in the last couple of weeks. Let's see, as far as the kind of the spread of the type of investments, you can see the green ones are the real high dollar amounts, residential only, residential, and coupled with retail and other types. That's the largest tranche of $12 billion. And then commercial, multiple investment type, about 10 billion. And then hospitality, about 2.2. That certainly, I had a few clients with large hotel projects that dried up after COVID hit, but those things are coming back with a vengeance now. The current opportunity zone legislative landscape, and Novogradic just had their national conference, so we got some pretty good input from Washington, D.C. speakers. So there is a House bill out there that would extend, and let me just go over, it's probably a good point to, for those of you that aren't familiar with the tax benefits. So there's really three tax benefits associated with an opportunity zone investment. Number one is when you roll your gain into an opportunity zone fund, that starts a deferral period. And under current law, you don't recognize that gain until December 31st, 2026. You would pay the tax in 2027. One caution, we don't know what the tax rate's going to be on December 31st, 2026. So you could be deferring gain and then paying tax at a higher rate. We've run the numbers, and as long as you're getting 2.8% return on your investment during that deferral period, even if the rates go up to 43.4, it's a wash. Wouldn't be great if they were that high in 2026. I don't think they'll be that high, but the fact is, as long as you get 2.8, it's a wash. If you've held your investment for 5 years on December 31st, 2026, and that would happen as long as you make your investment into an Oz fund by the end of this year, you get a 10% basis bump in your investment. So let's say you're deferring $1 million. Instead of reporting $1 million of gain, you would only report $900,000. You get a 10% haircut in your recognized gain. Then if you hold the investment for the full 10 years, let's say that $1 million investment ends up being worth $2.5 million. In that case, that $1.5 million increase is completely exempt for federal tax and all states except for California, Mississippi, North Carolina, Massachusetts, and now New York. But all the other states conform. So there is some legislation out there that would push, and it's bipartisan, that would push the recognition date till 2028. If that happens, then if you made an investment by the end of this year, you would have a 15% bump in your basis by 2026 because you would have held it for 7 years. That opens up the door for added benefits and 2 more years of deferral. We get the question asked all the time, hey, with the new administration, what does that mean to the Oz program? A lot of people don't realize it, but the real architects of the Oz program were in the Obama administration. It just happened that the legislation didn't pass until the Trump administration, and Trump, being Trump, took full credit for the program, and he was a great cheerleader for it. But it is very bipartisan. We had Cory Booker as well as Senator Scott's legislative aide speaking last week at the Novogradac conference. And they are both very optimistic about the program. They love the overall impact on it. And really, Biden has announced that he would like to see the Oz funds team with local nonprofits. He'd like to have some additional investment disclosures so that we can track what the benefits are to the community and things. And then he wants to monitor the effectiveness and see how it impacts the residents of these economically challenged census tracts. And to add, Kamala Harris is also a big fan of the entrepreneurial aspects and using them for operating businesses. So I think we have a continued support from the administration. State taxes are also, on the rise with all of COVID's impact. A lot of states are starting to increase their tax rates. So again, this ability to defer and ultimately get tax-free treatment is a real positive. And as I already discussed, the capital gain rate increases is just going to make the program just that much better. So again, all of you are real estate focused. A common question we get is, why should we do this versus a 1031 transaction? And I'm going to tell you, 1031s, you want to do a 1031 if you're in any of those states that I mentioned that don't conform, because that way you'll get a deferral for both federal and state. So we always start off looking at a 1031 if you're in any of the 5 states that don't conform. The opportunity zone benefits, the deferral is only till 2026, whereas 1031, you have total control of when you dispose of replacement property. Original gain elimination, you do get those basis step-ups in a opportunity zone scenario, so that makes it more attractive. You don't get any step-up in a 1031. As long as you put a debt layer in there, you're going to get more depreciation typically out of an O-zone project than you would a 1031. And the biggest thing is you don't have that 180-day limit to find a piece of property. Once you put the money into the opportunity zone fund, as long as you drop that money down into the qualified opportunity zone business by June 29th, you have 55 months to figure out what you're going to do with it, to find land, to build something. You can't build a project in a 1031 context. You're stuck with something that's already built. It's just tremendously flexible. The one negative, and I do always ask, how old is the person that's rolling the gain? Are they in good health? Because here's one big difference. If somebody dies in the middle of the 10-year period, you don't get a step up in your Oz fund. Now your heirs will step into the shoes of the original investor. If they're 5 years in and they have to hold it for another 5 years, they have to get across the 10-year finish line. So that is one big difference. But I should also point out, because I did read through the White House tax policy statement last night, Biden has threatened to get rid of 1031 transactions, which again will drive everybody to O-zone deals. He may keep them, but for very small transactions. I think he had like a $250,000 limit. And then also he may get rid of the step up in basis upon death. And so those two things will push more people, I think, to opportunity zone transactions. This just kind of summarizes geographic focus. And I think the slide deck will be available to you. You have a lot of naysayers out there. There's been a few studies that have said, the program's ineffective and things. Well, there was no clarity for 2 years on exactly how the program was going to work. We had to wait there were 4 sets of regulations. So it took a long time to get clarity. But once the clarity was out there at the end of 2019, we definitely saw a lot of money pouring in. There's over 8,700 census tracts that you can invest in. I do want to point out the 2020 census changed those, and about 60% of the census tracts got redrawn a little bit. And we don't know right now, the way the code is written, that the original census tracts are kind of carved in stone. So it would take an act of Congress literally to change those. But I would tell you that if you are buying a piece of land or a building you definitely want to double check and make sure that those borders haven't changed, because there is some slim chance that Congress could change those. But consensus is what was drawn in 2018, that those are going to stand for the duration. So we kind of covered this, again, 3 areas: the temporary tax deferral, basis bump, and then ultimately the tax deferral. Get asked all the time, a lot of people think, oh, the 10-year clock doesn't start till you invest in that new piece of real estate or that new business. It actually starts the day you move it into the Oz fund. So you could move it to the Oz fund, sit on it for 2-3 years, figuring out what you want to do. And you don't have to hold that asset for 10 years. You just have to hold the Oz fund for 10 years. So it's very liberal. It's very broad, the types of gains that you can put in. And also, you don't have to net. So somebody could have $1 million of capital gains, $900,000 of losses. They can roll $1 million of gain into an Oz fund and then just carry over that 900,000 and use it in a later year. So again, very, very flexible. You can do installment sales and kind of spread out how you invest it. This is the general structure of the qualified opportunity fund up on top. Just think of that as a bank account. It really isn't used that much other than a conduit. And then you drop the money down into the qualified opportunity zone business, in this case, a partnership. By doing that, you get the longer period of time to reinvest it. And it's also, you can have 30% what we call bad assets down in this subsidiary entity. So you could have some assets that are outside of an opportunity zone, and you won't ruin your opportunity zone structure. You can't have certain sin businesses: golf courses, country club, massage parlors, hot tubs, racetracks, or gambling. We did, one of our clients, they're repurposing the Reno Harrah's casino into residential, and the casino wanted to run it for another year, and we couldn't even lease it to them. So there's some really strict rules on that. I know this is a pretty busy slide, but I'll just get to the punchline that this is a non-Oz fund investment, earning 5% a year, very nominal, I realize, in the real estate world, but it shows that at the 5 and 7 year, after you pay taxes, you're in the red. And after 10 years, you'd only be after tax at a 12.7% cumulative rate, just about 1% a year benefit. Just again, with that really nominal rate in an Oz fund context, it drives that return up to 42% cumulative, almost 4.1% on an annual basis. And then if we bump it up to something that would get you more excited, a 15% rate, now we bump it up to 284%. And even if you only held it for 5 years and didn't get the 10-year benefit because of that deferral, and you had a bigger investment because of the deferred taxes, you'd still get a 53% return over that 5-year period, or 10%. And then when you leverage these, which you're always going to do in a real estate world, it just really pops the benefit. And this doesn't even factor in the tax-free depreciation you're going to get. So it's pretty incredible. When I first looked at the program, I was not sure my clients would like it, and then I ran the numbers, and I was sold. Again, this is a very busy slide. You'll want to look at it later, but I have this in here. There's some really strict rules. Let's say you own a piece of land, this typical development deal. You want to participate in the development, and so you contribute that land to an Oz fund. Well, there's all sorts of restrictions on that. It can be done, but you have to be very careful. Sometimes it's better to contribute. Sometimes it's better to sell. Anyway, we've got a matrix. This is probably about 100 hours of work that went into to devising, all the different ways to get it in. And sometimes we end up, out of necessity, we just do a ground lease with that land. But there's some really interesting analysis that's done on this, and we've got some big projects in LA. We wanted to save the property tax base too. It's very, very complicated, but we can help you with that. The 180-day reinvestment period is a real misnomer. It's very seldom. You only have 180 days in this situation. If you, let's say you own Apple stock and you sold the actual shares in your own name, that's a strict 180 days that you have to reinvest it into an Oz fund. Most of the gains we have are coming through on a K1 because you were in a real estate deal, you're in a partnership or an S Corp, you sold your business. If that happens, the 180 days does not start until March 15th of the following year. And so you could have sold something January 1st of 2021. You wouldn't have to reinvest that until September, early September 2022. So that's just a huge difference between Oz funds and 1031 transactions. Again, complicated. You'll want to look at this offline, but this is just kind of the gating, what we refer to as, how long do you have to identify projects, reinvest, et cetera. 5 ways that you can use the program. Great. I've used it so many times. Safety net for a blown 1031 transaction. So, and you can have up to a 4 or 5 year replacement period rather than the 180 days. And so you might have successfully reinvested part of it through a 1031, but you end up with a bunch of boot. The Oz program can save you on that. Also, if you just we have this all the time. You have family partnerships and you have a bunch of siblings that don't get along, or they're trapped in an S Corp, which isn't the ideal situation to have appreciated assets. If you sell an asset, rather than doing a 1031 and just continuing the pain, let the gain flow out, let the people that want to reinvest together reinvest, the other people can go their own way. Highly, highly flexible and efficient for people. And then, as I mentioned, leverage is your friend in the land of Oz. You want to leverage the heck out of these to get the maximum benefit. So key takeaways: 180-day period is almost always way longer than that. The QOF formation and self-certification dates. Once you put it in the qualified opportunity fund, you can breathe easy. But there is a little bit of a panic to get the money in there timely. But once it's in there, you've got tremendous flexibility. We almost always have a 2-tier structure. I haven't been involved in any that's a single tier structure. It just doesn't give you the flexibility that the 2-tier structure has. I've already talked about the related party situation. You use 1031s if you're in any of these non-conforming states. The ideal Oz candidate, realize large capital gains. Get the question all the time: how much gain do I have to set up my own, to justify setting up my own fund? Probably at least $250,000. Early on, I would say $1 million, at the very front of the program, but we can, $250,000 is usually sufficient. Also, anybody that just wants to diversify their investments, they sold a business, now want to get into real estate, or they want to get out of real estate and go start a business or do some temporary investments. Has a botched 1031, relatively young and in good health because of the inheritance issue that I mentioned. And they have to be patient. You're going to have to hold on to this for 10 years to get your full benefit. It's a slide with some great resources. You can check our website, hcbt.com. Novogradac has some fantastic information on their websites also. I'll turn it back to you, Kevin.
Yeah, appreciate that. That's fantastic information. And as expected, there's a ton of questions on the floor. I could probably select a couple out here, but I know we're going to be a little bit pressed for time. So I think what we'll do is we'll do direct outreach coming out of today's session. And that's either going to come from Blake Direct or Blake's group or from Millionacres or some combination of both. Just because I think given the volume, I don't think we can be fair and handle all the questions today. So stay tuned for that. What'll happen is we'll get an email out to you within the next couple of days that will have a copy of the recording, and it will hopefully have maybe an FAQ document on some of the questions.